Today, we're going to have a look at whether the unrealized losses on Bank of America's bond portfolio is really something to worry about or not. And then we're going to focus on Brent crude trading just above $90. Is it time to start worrying? And the trading takeout today is going to be focused on, unfortunately, conflicts and how they play out in markets. Because we tend to see a lot of furore, but there's only a few turning points that actually matter. We're going to identify what they are. Now, the only way you can get the best trading insights, education, and analysis each day is if you're here every day. So hit subscribe so you can get your daily trading edge. So, yes, Bank of America's Q3 earnings came out yesterday, and there was a specific interest in one segment of the report, which is down here, and it's called Total Held to Maturity Debt Securities. I'll zoom in on that just a little bit. And it was really this figure here, negative $131 billion in terms of a loss. So not negative, a loss of $131 billion, $600 million is identified there. And, you know, social media goes mental over these things because they tend not to understand things, unfortunately. And doom sells at the end of the day. So it's time to sort of right some wrongs. Now, what does this actually show? Well, first, you have to hear the initial first words of it, held to maturity. Okay, the way a bond works is that if you hold it all the way to maturity, especially a treasury bond or anything that is backed by the US government, which predominantly this is mortgage-backed securities, but they are backed by the Fed and the US government now. Anything that is held that is sort of AAA rated in that way is deemed to be, you know, pretty safe, and you can class it as being able to be held to maturity. And the way that bond works is that whatever the face value of the bond is, so let's say you bought $100 million worth of bonds at a 3% yield and the maturity is 10 years, okay? You would earn that 3% yield over the lifetime of the bond, plus all of the face value of the bond back, so you'd receive $100 million back, plus the principal, net of any inflation costs, obviously, which are explicit to the actual equation, I guess. And so this kind of flies in the face of any sort of analysis that these guys are doing. I'm not saying Jack's fantastic. He's just identifying this. But this flies in the face of any doomy analysis that people are trying to pull. Many are trying to equate it with Silicon Valley Bank, who indeed had a lot of held to maturity securities, but their problem was that they didn't have the liquidity profile to match any kind of outflows for when, you know, things started to hit the fan, and they had to actually sell down these securities. So they were realizing losses. Bank of America, on the other hand, is a huge tier one bank, and they're not going to have the same outflows, basically. So they've got a much stronger liquidity profile than the likes of Silicon Valley Bank, and will not have to sell down these securities in the same way that Silicon Valley Bank did. So any analysis of this, again, I always say it, people that doomsay over things they don't understand, follow them, see what they say in the future, and see if they come into another false conclusion, because it's the easiest way to trade. You know, brokers, they look at who the uninformed people are coming through in their client flow, and they will internalize the flow because they understand that it's profitable to trade against them, basically, to internalize everything and to take the other side and hedge them out, basically. So, you know, it's a fantastic way of analyzing the minds of the uninformed here. And you can genuinely get alpha from this. Absolutely, there's alpha in understanding a group of people who can be consistently wrong on something. I would be wondering if they're shorting things right now, because if we go and then look at the Bank of America chart, you've got this rubbish news that's come out, apparently, but then you've got a massive trend line here, which, you know, is relatively strong, and we've just bounced off of it. So are they shorting into this? Are they trying to get out of their positions? Because to me, that looks like a massive gobble up over the last 3 weeks. We've traded below the low into the low of 2020. Sorry, not into the low, into the lowest price since 2020. And the market's just gobbled it back up. It doesn't look to me like there's any issues at all. And so the people that are suggesting that, these unrealized losses will become realized just don't know what they're talking about, and they've got a blind spot. So always focus on those who have blind spots. But the bottom line here is that held to maturity securities are literally by definition going to be held to maturity, so they can't realize a loss on the portfolio. So moving on to oil, and we have seen a bit of an uptick over the last couple of days to week, I guess, since the issues to do with Israel and Palestine have kicked off. Naturally, the Middle East is a massive oil producer, and any kind of uncertainty will lead to an increase in the price of oil. But the thing that we have to always remember is that even back in August, OPEC were suggesting that, supply cuts were in store. So we have to ask ourselves, okay, is this the trajectory that we were already on anyway? And has this this conflict that has kicked up, invigorated it a little bit? And we can see the price of Brent since the middle of August increased, and then we trailed off a little bit, and then we've gone back up again. To me, this is all very normal price action after what OPEC had been saying. And, whether there's cause for concern or not, I don't really know at this time. It seems like escalation is being spoken about a lot, but it's not really occurring. And even if escalation were to occur, I'm not so sure to the extent at which it would really, really affect oil markets hugely. I mean, it would cause an uptick, but I don't know if it would be sufficient to displace the issue where demand at the moment is so flat. And demand comes in waves, obviously, but the problem right now, and I'll keep alluding to it, is that the forward curve just looks so flat and downward sloping as we look, out to January and 2024 onwards. So it doesn't really indicate there's much demand. And this price spike is predominantly, in my view, driven by OPEC. There is also the fact that oil is being pressed higher here because traders can't access the same credit facilities as they could pre-pandemic. So you've got a tight supply still and tight ability to move it, whilst also requiring higher margins. It gets a little bit complex now, but basically oil used to be, and this is from a large oil trader in South Africa that I spoke with just last week, oil used to be very much a volume business, but now it's changed very much to margin focused. And what that means is that you require larger credit facilities, So the fact that these credit facilities haven't necessarily increased is an issue. And I think that what they were alluding to is that traders are just trying to press the price higher because there's not as much volume, and so they need to make money somehow, I guess. Focus for me, though, really is if we do start ticking up towards 96, are we in for a situation similar to 2008, where we start ticking up to, the mid hundreds. So $140. I think we tailed off at 148-ish up in 2007, or was it 2008? 2008, yeah. So that is the biggest cause for concern for me. And so, it remains to be seen to the extent of escalation. But I'm going to talk in the trade and takeout about how wars kind of work and operate. And as we've seen with Ukraine, just because there's a war going on doesn't necessarily mean that things will be decimated for a very, very long time, especially in the context of the Middle East. So wars and the context of wars in markets. It's a very, very difficult topic. And it's very difficult to talk about trading when wars and conflicts are occurring, because people then just think, oh, you don't care or whatever. When unfortunately, it's a factor of the job. You have to think of the context of war within markets. And, one thing that always comes up is the emotive side of war versus, how to actually function and think rationally in markets. And really, there's only a few turning points in wars. There's escalation and de-escalation, and that is all that really occurs. And the only things that I would focus on when it comes to escalation are other countries getting involved? That is really it. And de-escalation is just the opposite. Are we subsiding in casualties? Are we, coming to points where talking is becoming more apparent? Because that tends to be obviously a nice barometer of wars coming to a close or conflicts coming to a close. But in terms of escalation, I would never, ever look at disasters almost. I would only look at which other countries are becoming more aggressive or hostile. That it's the most objective way to think about things, because if you get stuck into a hole of thinking, they did this, they did that, it doesn't actually matter for markets. It's just something to debate and argue about, unfortunately. And so the way that I would think of it is, okay, purely, are other countries getting involved? Can this spill over? The spillover effects and contagion are what always matters.